I'm going to discuss a few of the strengths and weaknesses of the Dodd-Frank Act, along with recent efforts to scale back the regulatory burden. The discussion is based on joint work with my Stern colleagues, Matt Richardson and Larry White, as well as with Brandeis professor Steve Giacchetti. I also have benefited greatly from the series of Stern faculty books regarding post-crisis financial regulation. After 8 years of Dodd-Frank and following the change of majority in the U.S. government, it is natural for us to ask what works, what doesn't, and what's missing. Let me begin with 5 conclusions. First, Dodd-Frank has made the U.S. financial system more resilient, but also increased the regulatory burden. Second, as Matt, Larry, and I emphasize in the annual review paper, there exists a key policy trade-off, namely, higher levels of capital can substitute efficiently for other regulatory interventions. Put differently, there are diminishing returns to regulation once a large intermediary is adequately self-insured. Third, the U.S. government recently has sought to ease compliance costs for small banks, but it also has scaled back oversight of larger intermediaries that can pose threats to the financial system. Fourth, some aspects of Dodd-Frank, especially the Volcker Rule, are not cost-effective. Finally, there remains considerable scope to reduce threats to the financial system. So, which aspects of Dodd-Frank have made the financial system safer? First, together with new international standards, the Act motivated large increases in capital at systemically important financial intermediaries, or SIFIs. Second, to monitor capital adequacy, it introduced a credible stress testing regime that has become the de facto capital planning framework for SIFI banks. Third, it created a SIFI resolution regime that, while untested, makes it somewhat more likely that policymakers would refuse to bail out a large intermediary in a crisis. Finally, it supported tougher limits on liquidity and maturity transformation. At the same time, Dodd-Frank also raised compliance costs, not least by restricting the scope of activities in ways that are not closely linked with risk. In response, there has been a consensus to scale back the regulatory burden on small institutions, but there is disagreement about what to do with larger intermediaries. To what extent has Dodd-Frank made the U.S. financial system more resilient? Without a model that embeds the counterfactual, it is difficult to say. However, useful indicators of risk have declined notably since the law was enacted. Consider, for example, our preferred measure of system-wide capital adequacy, the Stern v. Labs S-risk. U.S. aggregate S-risk has plunged by more than 80% from its peak in 2008. More specifically, since the enactment of Dodd-Frank in July 2010, U.S. S-risk has dropped by nearly 1/2. In contrast, European S-risk has declined by less than 1/4, while Asian S-risk has soared by a factor of more than 3. Excluding China, Asian S-risk is up by about 2/3. Sorry about that. There it is. My apologies. In our view, higher capital requirements on SIFIs have been a particularly cost-effective tool helping to lower S-risk. As the Choice Act assumed, an intermediary with more equity capital poses less risk to the financial system. And by revealing the adequacy of capital in the bad state of the world, a credible stress test is a key complement to higher capital requirements. However, in contrast with our observation favoring self-insurance for SIFIs over other forms of regulatory intervention, the recent government effort to scale back regulatory burdens has not excluded capital requirements and stress tests. Earlier this year, for example, Congress enacted a new law, the Economic Growth, Regulatory Reform, and Consumer Protection Act, that's a mouthful, that relaxes scrutiny of larger banks in the name of easing the burden of small banks. The Act's most widely known feature raises the asset threshold for bank SIFI status from $50 billion to $250 billion, thereby shrinking the number of SIFIs by about 2/3 to 14. It places the burden on the Fed to show that banks in this medium range, $100 to $250 billion of assets, still merit closer scrutiny. It also eases the leverage requirements on some larger banks and allows a reduced frequency of stress tests. The new law implies that far too many institutions initially were included in the SIFI class. However, there's good reason to be skeptical about relying on balance sheet size as the sole benchmark for closer regulatory scrutiny. To be sure, as the chart here shows, the largest 6 banks all fall far north of the $250 billion marker, the blue line shown in the chart on the vertical blue line. These scores on the vertical axis are based on 11 indicators used by the Basel Committee on Banking Supervision to assess banks' interconnectedness, their substitutability, their complexity, and their cross-jurisdictional activity. However, once you get below the scale of the 6 behemoths, size is overrated as an indicator of risk. To make this clear, I've excluded all banks with assets greater than $500 billion. Otherwise, the chart is the same. Now we see that several banks in the range of $100 to $250 billion have substantially higher risk scores. Those are the ones marked in red in the bottom left quadrant, than those in the $250 to $500 billion class, the ones marked in blue. Going forward, increased regulatory arbitrage at the $250 billion cutoff may amplify these differences. In addition to legal changes, discretionary regulatory changes have scaled back the oversight of SIFIs, especially at non-banks. As of 2014, the Financial Stability Oversight Council, FSOC, had designated 4 non-banks as SIFIs: AIG, GE Capital, MetLife, and Prudential. Credible designation authority creates incentives for those firms wishing to avoid higher capital requirements and greater scrutiny to adjust their business models accordingly. Indeed, following evidence that they had de-risked their businesses, FSOC rescinded the designations of GE Capital in 2016 and 2017. 1 year ago, Treasury argued in a report that FSOC should prioritize industry-wide activities regulation over entity regulation. This makes considerable sense, especially for the asset management industry where, with a few exceptions like money market mutual funds, the investors rather than the managers assume market risk. However, we have seen no subsequent wave of activities regulation. Moreover, for entities that are able to conceal risk, it is doubtful that activities regulation alone would be sufficient to ensure financial resilience. Yet today, there are no non-bank SIFIs. FSOC rescinded the designation of Prudential last month, while earlier this year, Treasury withdrew its appeal of a 2016 court decision that overturned the designation of MetLife. Were these reversals warranted? FSOC's October rescission notice states that the firm's aggregate capital markets exposures were largely unchanged since its 2013 designation. And they added that its complexity still made it a challenge to resolve. Otherwise, the heavily redacted rescission document does not allow us to independently assess whether Prudential's business has become safer. So let's turn to a market-based measure of leverage, namely the ratio of market value of equity to the sum of debt and the market value of equity. For Prudential, depicted in red, there is no evidence of a material change over the past 8 years. Prudential's market leverage ratio also is lower than that of both MetLife and AIG. Note, this is not a gearing ratio, it's the regulatory leverage ratio, equity to the sum of equity and debt. It's also far below the ratio that prevailed in late 2007, ahead of the worst year of the crisis. Keep in mind that the largest life insurers today are far more like other intermediaries than their traditional business model implies. As Acharya and Richardson have argued, the industry now offers products with non-diversifiable risk that are more prone, it is more prone to a run. It insures against macro-wide events and has expanded its role in financial markets. The bottom line, in my view, by eliminating non-bank CFIs and by raising the threshold for future designation, Treasury and the FSOC are encouraging intermediaries to take on, large intermediaries, to take on additional risk that could very well increase the likelihood of a crisis. Let me now turn to an opportunity to lower compliance costs without diminishing resilience. I'm talking about the Volcker Rule. The aim of the rule is simple: to prevent banks from funding speculative activities using liabilities subsidized by the government, for example, through deposit insurance. Yet the Volcker Rule as implemented today is not Paul Volcker's rule. Over the 5 years of its gestation, the rule as promulgated by federal regulators became long and complex. It's also overseen by 5 different federal regulators. Earlier this year, the Fed requested comments on a proposal to simplify it. One key problem with the rule is that it does not directly address risk. An example makes it clear. While a bank can make and trade corporate loans, it cannot buy and trade corporate bonds for its own account, nor can it invest beyond a small amount in a private equity fund that makes corporate loans. The underlying risks of these instruments may be the same, but the rule's treatment sharply differs. A second problem is that there is no simple way to distinguish market making from proprietary trading. The rule establishes a complex set of exemptions that require costly trade-by-trade oversight to ensure compliance. The point is we can do better. Higher capital requirements on CFIs combined with an easing or even an elimination of the Volcker Rule likely would lower compliance costs while making the banking system safer. This is a classic example of the regulatory trade-off that the annual review paper highlights. That brings me to my final point. Both recent legislation, whoops, did that go off? Well, sorry about that. That brings me to my final point. Both recent legislation, oops, maybe I can squeeze it down now. Both recent legislation and discretionary actions overlook important opportunities to make the financial system safer and more efficient. At the top of the list would be a streamlining of the U.S. regulatory framework. Today's Rube Goldberg-like structure makes it nearly impossible for anyone to view the financial system as a whole or to detect its vulnerabilities. The U.S. approach not only weakens oversight and crisis management, but it also can raise entry barriers, for example, for fintech startups. Second, there is plenty of scope for increased transparency as a means to promote market discipline. One example, simple example, would be to report regularly the extent of the resources that central clearing parties can call on from their clearing members in a crisis. Today's CCPs are so enormous and so central to the global financial network that their distress can be transmitted instantly around the world. Third, in my view, there remains considerable scope to hike capital requirements on CFIs gradually further. At the same time, we should watch out for unintended side effects, such as diminished credit supply or a shifting of risk beyond the regulatory perimeter. Finally, threats to the financial system from cyber risk and other forms of operational risk have grown massively. One reason, ironically, is the success of Dodd-Frank in shifting the trading of derivatives from over-the-counter to central clearing. Having put all of our eggs in a few CCP baskets, we need to ensure that those baskets are safe or make arrangements for their instant repair. Thank you.